Right, friends. Chalo. So now let's do this problem number 8. There are 3 problems that we have left. I think we are done till problem number 5. We don't have time to solve all the sums. As I told you, I'll be selectively taking a particular sum and then eventually solving it, because we need to go for process costing and so many other chapters. Okay, so let's take this problem number 8. We'll move on. So the budgeted production of a company is 20,000 units per month. The standard cost sheet is as under. You got direct materials, direct labor, variable overheads, fixed overheads, selling price. The following are the actual details for the month. You got actual production and sales. There is no change in selling price. Direct materials consumed, direct labor hours worked. That is 1,18,125 hours at rupees 6 per hour. Actual overheads were rupees 5,65,000, out of which a sum of 40,000 was fixed. And material consumed information is also given, which is 29,860 kgs at rupees 5.25 per kg. Everything is fine. So you are required to calculate almost everything: material, labor, variable overheads, fixed overheads, and sales variances. Although he has asked you specifically, but for the sake of practice, we'll calculate all the variances. Okay, I've chosen this particular sum. Why? Because it's all variance computation sum, so that we need to start right away from material variances, and then we have to go all the way to sales variances. Or you can start with sales variances, then material, labor, variable overheads, fixed overheads, and so on. So because we have to calculate all the variances, it will be a good practice for you, and that's the reason I've selected this particular sum. Okay, now I'm going to give you 1 minute. Just look at the information, because looking at the information is very important. One of the major reasons why standard costing is difficult for a majority of you people is because you ignore reading the sum. For example, you have this info: direct materials. How the info is given: 1.5 kgs at 6 per kg. Okay, that info should be there temporarily in your mind, at least, like, Gajni kind of a memory should be there at least for 15 minutes. Direct labor. So just look at the question and try to get the frame of it in your mind. Then it will be easy for you when you put the formula, and you need to search for the numbers, where to put it in that respective formula, so that you can do the sums without any confusion or kind of errors and stuff like that you can avoid eventually. Okay, so therefore, just look at the sum, just look at the figures, just try to understand what are all the figures that has been given in the question. Then eventually solving of the solution will become easier. Okay, do that. We'll start. Right, friends, I hope you guys are done with your reading. Okay, chalo, let's start solving question number 8. Right, just a second, guys. Yep. Question number 8. Okay, now we need to go with all variance computation over here. Now remember this in your mind: whenever in any question he has asked you to go for all variance computation, always start with sales variances. There is a reason for that, but right now at CA interlevel that much is not necessary for you, but in case you may get a sum which will test you out, that as well, because sales variances talks about the output. All the remaining variances are input, which is direct material, direct labor, variable. So it's always better to start with output. There is a reason for that. Right now you can't understand unless I solve a sum which requires you to calculate the sales variance at the beginning. Right now just understand it as a rule. Okay, beyond that too much of understanding is not necessary for you. So just remember that when all variance kind of a question has been asked, where he has asked you to calculate all the variances, just remember that simply you need to start with sales variances, and then you will go for the other variances, that is material, labor, variable, or fixed overheads whatsoever. Okay, chalo. Now coming on to sales variances, if you look at the question, what is the way he has asked? Sales volume variance in sales value and gross margin. Okay, so which means he has asked you sales variances in sales value, means that is total approach, correct? In total approach you will find the whole value. Margin means that is margin approach. In margin approach we have got absorption costing and marginal costing. We'll do everything because we are doing this sum as a practice, so we're gonna do everything. In examination under margin approach, if you do just one, it's enough, either absorption costing or marginal costing. Anyway, chalo, now let's go for sales variances. Now see here. Okay, now the first thing is, do we have any multiple finished goods in this question? If you look at the question, if you look at the info, there is no multiple finished good, there is just one type of finished good. So in that case, my pro forma will be total sales variance will be divided into two: sales price variance and sales volume variance. Okay, volume variance will be further divided into mix and quantity. Now that will come only when you have multiple finished goods, that is more than one type of finished goods. So fortunately we don't have multiple finished goods over here, so it stops right here. So we'll put the formula over here, 1, 2 and 3. The first one, yeah, total approach, so BQ into BP. Second one, AQ into AP. Third one, AQ into BP. Now please try to understand that there is no question of standard here. I would have explained you the logic when I explained you the formula itself, when I explained you the concepts of sales variances. There I have explained you the logic why standard word should not be used when it comes to sales variances. Okay, so all the standard will be replaced by the word budget. So here you don't have standard, so which means only two options are there: budget, actual. When it comes to the cost variances, that is material, labor, variable overheads, fixed overheads, you have three options: budget, standard and actual. Whereas when it comes to sales variances, there are only two options: budget and actual. Logic for that I have explained you already in the earlier videos. Okay, chalo. Now, so what about the formula? Same formula: 1 minus 2, 3 minus 2 and 1 minus 3. There it goes. Right, let's try to put up the figures over here. Right, so BQ into BP. Now look at the question and let's pick up the numbers. Budgeted quantity, yeah, it's there in the first line itself, which is 20,000 units. Okay, into budgeted selling price, yeah, 72. It's easy to pick up, right? I'll just show you over here. So here you got budgeted production of the company is 20,000 and here you've got a selling price which is 72. Because there is no stock here, obviously what you have produced you will be selling, so no confusion over there. Actual quantity that you have sold, that is also there, 18,750. You just need to look at the question. From question only I'm picking up all the numbers. Okay, as you can see here, 18,750 clearly given, which is actual production and sales. Into actual price, there is clearly a sentence saying that there is no change in selling price, so obviously actual selling price will be similar to budgeted selling price, so that's done. Actual quantity again 18,750 into budgeted selling price is how much? 72. That's obvious. Okay, so just a second guys, speak my... Okay friends, I just got my calci, so it's gonna be 20,000 into 72, that is 14,40,000. 18,750 into 72, 13,50,000. This also will be 13,50,000. So that implies what's gonna be your total sales variance? 1 minus 2, 14,40,000 minus 13,50,000, 90,000. What is this? 14,40,000 minus 13,50,000, so 90,000 positive. Positive means favorable or adverse? Adverse. Adverse. Why? In sales it is different. See, when it comes to cost variances, plus is favorable, minus is adverse. When it comes to sales variances, minus is favorable and plus is adverse. Why? Because logic is very simple. If cost increases, it is adverse. If cost reduces, it is favorable. If sales increases, it is favorable. If sales reduces, then it is adverse. So the relationship is exactly opposite. That's why, for example, see, forget about all this formula, blind rule and all. Use your common sense. Your budgeted quantity that you thought of selling is 20,000. Actually you have sold 1250 units less, so obviously what will happen? Your profit would have got reduced or increased? Reduced. So I told you, when the actual profit reduces, is it favorable variance or adverse variance? Adverse variance. Very simple, you got the point. But this much of thought process to think in the examination, unfortunately because of our examination style, we don't have that much of time. So therefore what we have to do is that just go with the blind rule. It's easy, so that we can do things faster and will not run out of time in the examination. Anyway, So 3 minus 2, there is nothing, so it is nil because there is no price variance because your budgeted selling price and actual selling price are same. Volume variance obviously 1 minus 3, which is going to be the same, which is 90,000 adverse. Got it? Chalo. Now this is as per total approach. Now again we have to do sales variance. As per which approach? Margin approach. You can call it as margin approach or profit approach. Under that, first I'll go for as per absorption costing system. Okay. Now before we get to that, we need to find two things. One is budgeted margin, other one is actual margin. It is nothing but budgeted profit per unit and actual profit per unit. Budgeted margin is nothing but budgeted selling price minus total standard cost per unit as per absorption costing system. Actual margin is nothing but actual selling price minus total standard cost per unit, or in other words standard cost per unit only. It is not actual cost per unit. I explained you the logic for this as well. Why? Normally people feel that actual profit or actual margin is equal to actual selling price minus actual cost per unit, but it is not actual cost per unit, it's standard cost per unit. The logic behind that I've explained already, okay, in the earlier videos when I was explaining you the formulas. Anyway, when I was explaining you the formula, right? Now we need to find out budgeted selling price, which is 72, minus total standard cost per unit. We need to find out. How to find out? Very simple. See here, material, here you have information 1.5 kg into 6 per kg. That will be the cost of material per unit of output, right? Direct labor 6 hours into 5 per hour, variable overhead 6 hours into 4 per hour, fixed overhead 3 per unit. Directly it is given. If you add all these things, you'll be getting total cost per unit. Of course it is standard cost. That entire table is, that entire box is standard cost. Okay, so let's calculate standard cost per unit. First, direct material, how much? 1.5 kgs into 6 per kg, that implies, so 1.5 into 6, that comes to 9. Direct labor, okay, it is around 6 hours into 5 rupees per hour. So 6 hours into 5 rupees per hour, that comes to 30. Next, variable overheads, 6 hours into 4 rupees per hour, that comes to 24. Next we have fixed overheads, which is directly given per unit, which is 3 per unit. That will leave you your total standard cost, which is 9 plus 30 plus 24 plus 3, 66 per unit. This is your total standard cost. Okay, now let's put it over here, minus 66. That gives you 6 rupees per unit is your budgeted profit or budgeted margin. Actual margin also will be same. Why? Because anyway your selling price is same. So actual selling price, budgeted selling price is same, which is 72 and 72, and standard cost is anyway same in the formula. So this also will be 6 per unit. Got it? So now let's go and calculate the variances. The formula is total sales margin variance will be divided into two: sales price margin variance, sales volume margin variance. Formulas will be same: 1 minus 2, 3 minus 2, and 1 minus 3. Okay, right. So let's go with that now. 1, 2, 3. So first one, budgeted quantity into budgeted margin. Okay, actual quantity into actual margin, actual quantity into budgeted margin, right? Now what is the budgeted quantity that you thought of selling? Very easy, it's given in the question, which is 20,000 units into budgeted margin. Just now we have calculated, which is 6. Actual quantity that you have sold is given in the question, which is 18,750 into actual margin is 6. Actual quantity is again 18,750 into budgeted margin is 6. That's quite simple. So 20,000 into 6, it comes around 1,20,000. Here 18,750 into 6 comes to 1,12,500, right? Here also it will be 1,12,500. Let's put the numbers over here. So 1 minus 2, 1,20,000 minus 1,12,500. 7,500. Obviously adverse. Why? Because it is positive, so positive means adverse. Because you have sold less number of units, so obviously it will be adverse. Your actual profit would have got reduced. 3 minus 2 is price variance. Obviously it is nil because 3 and 2 are the same. Volume margin variance is again the same, which will be 7500 adverse. So this is as per which system? Absorption costing system. That is the reason you have reduced total standard cost, because as per absorption costing system, budgeted margin means profit. Actual margin is also profit. Now let's do the same as per margin approach, but not as per absorption costing system, as per marginal costing system. Okay, let's do that. See here. Sales variances, margin approach, marginal costing system. Again, we need to calculate budgeted margin and actual margin. Okay, how are we going to calculate as per marginal costing system? What is the formula? Budgeted margin is nothing but budgeted selling price minus not total standard cost, it is standard variable cost. Because as per marginal costing, we'll calculate contribution, not the profit. So that's why we reduce only variable cost. Actual margin is obviously actual selling price minus standard variable cost. That implies. Now what is the standard variable cost? Let's calculate. Direct material we know, which is 1.5 kgs into 6 per kg, which is a variable cost. So I will take it, right? Which is 9. Direct labor, again variable cost, which is 6 hours at 5 rupees per hour, which is 30. Variable overheads, again variable cost, 6 into 4 rupees per hour, 24. Fixed overheads I'll not take because obviously it is fixed cost. So 9 plus 30 plus 24. So it comes around 63. That's your variable cost. So budgeted selling price is 72 minus standard variable cost is 63. You'll get the margin as 9, which is nothing but contribution. So this is contribution. So as per marginal costing, budgeted margin means contribution. As per absorption costing, budgeted margin means profit. Keep that in mind. This is also same, 72 minus 63, which will be 9. So as per marginal costing system, your margin is nothing but contribution, whereas as per absorption costing system, your margin is nothing but profit. That is the difference. Okay, now let's go with the pro forma. Total sales margin variance will be divided into 2 only, because there are no multiple finished goods. Sales price margin variance, sales volume margin variance. 1 minus 2, 3 minus 2, and 1 minus 3. Let's go for 1, 2, and 3. Okay, let's go with the first one. Budgeted quantity into budgeted margin. Obviously, actual quantity into actual margin, actual quantity into budgeted margin. Got it? Now that implies, so budgeted quantity, how much you thought of selling? 20,000 into budgeted margin. Just now we have calculated as per marginal costing system, which is 9. Actual quantity 18,750 into actual margin, same as budgeted margin, 9. Okay, here actual quantity is 18,750 into budgeted margin, same, 9. Okay, so 20,000 into 9, 1,80,000. 18,750 into 9, 1,68,750. This is also 1,68,750. Got the point? Chalo, that implies, right? So what is that we're gonna do? 1 minus 2. So 1,80,000 minus 1,68,750. That comes to 11,250. Here 3 minus 2, nil it is. This is again 11,250. Okay, 1 minus 3. Got it? Chalo, that's it. Okay. Now every problem, if at all he has asked you to calculate all the variances and sales variances, do you need to really do it as per all these 3 different approaches? That is total approach, and then margin approach as per absorption costing, and margin approach as per marginal costing. At IPC level, that's what you have to do. Okay, right. Another thing is that if you could observe these variances, first look at the total approach. Anyways, so it's very simple. You just took the whole selling price when it comes to total approach. When it comes to margin approach, you went for profit as per absorption costing system. As per marginal costing system, you went for contribution. That's the only difference. Apart from that, it's pretty simple and straightforward. Okay, right. Now moving on to the next one. Now the next one is, we'll go for calculating material variances. Right, now let's go with material variances. Now, tell me one thing, if you look at the question, do we have single raw material or multiple raw materials? So single raw material, therefore material cost variance will be divided into two. Okay, so material price variance and material usage variance. Do we need to further classify material usage variance into mix and yield? No. Why? Because single type of raw material is given in the question. There are no multiple raw materials. Formulas will be same: 1 minus 2, 3 minus 2, 1 minus 3. Okay. Now, so 1, 2 and 3. What is the first one? SQ into SP. Second one, AQ into AP. Third one, AQ into SP. Okay. Chalo. Now, that is equal to. So what do you mean by SQ over here? Standard quantity of raw material required for actual output of finished goods. We have clearly seen the importance of SQ during the last sessions where I've explained you the formula. Okay. So standard quantity required for actual output. How to get it? Look at here. What is the standard quantity? 1.5 kgs. Okay, per unit of output. That is the logic. 1.5 kgs per unit of output into what is your actual output? 18,750. That is your standard quantity of raw material required for actual output. In other words, raw material that is allowed. 1.5 kgs is allowed per unit of output. How many units of output you have got? 18,750. So that implies standard quantity for actual output into standard price. So what is the standard price? Obviously 6 per kg. This entire box is standard, as you can see here, standard cost sheet. Okay, chalo, into 6 per kg, 6. Okay, AQ. AQ is nothing but actual quantity of raw material consumed for actual output of finished goods. Is it directly given in the question? Yes. As you can see here, direct materials consumed. Actually, as you can see here, the following are the actual details for the month. So direct materials consumed, which is 29,860. 29,860 into actual price, how much? 5.25. Actual quantity is 29,860 into standard price is 6. Okay, let's do the calculations over here. 1.5 into 18,750 into 6, 1,68,750. Okay, 29,860 into 5.25, 1,56,765. This will be 29,860 into 6, 1,79,160. Okay, pardon me if there are any calculation mistake. Okay, right, now 1 minus 2, what's gonna be the thing? 1,68,750 minus 1,56,765. so total variance will be 11,985. This is positive, so it is favorable. Price variance 3 minus 2, so 1,79,160 minus 2, 1,56,765. so 22,395, favorable again because it is positive. Usage variance 1 minus 3, 1,68,750 minus 3, 1,79,160. 1,79,160. so that comes around 10,410 negative. So it is adverse. Okay, set off obviously 22,395 favorable minus 10,410 adverse will give you 11,985 favorable. Okay, done. So that's your material variances. Let's go for the next one, labor variances. Okay, now as usual, before we start with the variance, do we have multiple labor in this question? No. Do we have idle time in this question? No. So which means our pro forma is going to be very simple. So labor cost variance will be divided into two: labor rate variance, labor efficiency variance. Okay, formulas routine: 1 minus 2, 3 minus 2, 1 minus 3. Okay, so 1, 2 and 3. So what is the first one? SH into SR per hour. Second one, AH into AR per hour. Third one, AH into SR per hour. Okay, that implies. So let's have a look into that now. SH means what? Standard hours of labor required for actual output. So what is standard hours? 6 hours over here. Actual output is 18,750. So which means 6 hours is required per unit into how many units you have actually manufactured? 18,750 into what is standard rate per hour? 5 rupees per hour over here. So into 5. हो गया. Next, actual hours into actual rate per hour. AH means what? Actual hours consumed for actual output of finished goods. So what is actual hours consumed? Is there in the question. This one. Okay, which is 1,18,125. So 1,18,125 into actual rate per hour 6 per hour, that is given in the question again. Actual hours is 1,18,125 into standard rate per hour is 5. Okay, that implies so 6 into 18,750 into 5, 5,62,500. Okay, here 1,18,125 into 6, 7,08,750. 1,18,125 into 5, 5,90,625. Okay, that implies, let's put the numbers over here. So 1 minus 2, so it is 5,62,500 minus what is 2? 7,08,750. So it will be 146,250 negative, so adverse. Next 3 minus 2, 5,90,625 minus 2, 7,08,750. That comes around 1,18,125, again negative, so adverse. 1 minus 3 for labor efficiency variance. So 1 is 5,62,500 minus, just a second, 5,62,500 minus 3, 5,90,625. So this will be 28,125, adverse again. Got the point? So I think we can verify. Rate variance is 1,18,125 plus 28,125, 1,46,250. That's the total labor cost variance. Got it? So I hope we are done with it. Right. Chalo guys, let's move on to the next one. After labor variances, what else we have in this question? Variable overheads. We know the pro forma variable overhead cost variance will be divided into 2. Okay, variable overhead expenditure variance and variable overhead efficiency variance. Formula remains the same: 1 minus 2, 3 minus 2, 1 minus 3. Okay, so 1, 2 and 3. What is the first one? Okay, before we get to that, we need to find two important things, as I told you. One is standard rate per hour for all overhead variances. Other one is standard rate per unit. You guys remember this? I've told you specifically when I was teaching you the logics behind the formula. Anyway, so standard rate per hour, it's pretty simple over here in this question. As you can see, variable rates 6 hours at rupees 4 per hour. So it is directly given. Standard rate per hour is 4 per hour. It is given in the question. Now what about standard rate per unit? That is also easy. One unit will take, look at variable rates information here. One unit will take 6 hours at 4 per hour. One unit will take 6 hours at 4 per hour, which means 6 hours into 4 per hour will be the cost per unit, which is 6 into 4, that comes around 24. Got it? Now as I told you, we'll be using frequently used formula generally, but here I'll show you both the formulas and eventually we'll solve both the formulas. So SH into SR per hour, first one. AH into AR per hour, second one. AH into SR per hour, third one. Alternative formulas: actual output into standard rate per unit, but this no need, standard output into standard rate per unit. Okay, now let's try to fill up the numbers and let us see whether both the formulae will give us same numbers. Okay, chalo. What is SH? Standard hours required for actual output. What about standard hours for variable rate? 6 hours. So 6 hours into actual output 18,750 into standard rate per hour, just now we have seen here 4 rupees, 4. Okay, so that implies actual output is how much? 18,750 into standard rate per unit is how much? 24. You see, exactly same. So 6 into 4 is nothing but 24 into 18,750. It's exactly the same. Next, actual hours into actual rate per hour is nothing but actual variable rates. Is actual variable rates is directly given in the question. I think you can see here. Actual overheads were 5,65,000, out of which 40,000 was fixed. So 5,65,000 minus 40,000, 5,25,000, that's your variable overheads, 5,25,000. Directly given in the question. We need not calculate anything. Here, actual hours we know, that is there in the question, 1,18,125 into standard rate per hour. Just now we have calculated here, which is 4. Okay. Now what about standard output over here? I told you standard output is nothing but expected output. Are you able to understand? What do you mean by expected output? How many hours you have worked? 1,18,125 hours you have worked. You are allowed how many hours to manufacture one unit? As you can see here, you are allowed 6 hours to manufacture one unit, correct? 6 hours. So which means how many units you should have manufactured? 1,18,125 divided by 6. 19,687.5. That is your standard output, 19,687.5 into standard rate per unit, which is how much? 24. That comes around 4,72,500. Okay. So if you calculate 1,18,125 into 4 also gives you the same number, which is 4,72,500. So either way you can basically solve it. Okay, that's the point. Got the point? Chalo. So both these formulas will give you same answer. So you need not worry. You can choose any one in the examination. Eventually you can do it. So variable overhead cost variance 1 minus 2. So 1 is, how much is 1? 18,750 to 24. 4,50,000. Okay, now you have got all the numbers. Okay, so 1 minus 2, 4,50,000 minus 2, 5,25,000, 75,000 negative, so obviously adverse. Okay, next variable overhead expenditure variance 3 minus 2, 3 is 4,72,500 minus 2, 5,25,000, 52,500. Again this is also negative, so adverse. Efficiency variance 1 minus 3, 4,50,000 minus 3, 4,72,500, so 22,500. That is also negative, obviously adverse. Pretty simple. Got the point, guys? Got it? Chalo. Done with it. So either of the formulas you use, eventually your answer is going to be same. That's, it's going to be the same. So that's a flexibility you should have when you're actually doing standard costing sums. Okay, right. Let's move to the last one, fixed overhead variances. Okay, first you have to do before solving this is see whether there is any information with respect to calendar variance. That is nothing but number of working days in a month. Is there any information in the question over here which talks about budgeted working days is equal to 25, actual working days is equal to 28? Something is there? No. Which means there is no possibility of calculating calendar variance. In that case, the pro forma will be fixed overhead cost variance will be divided into 2. Fixed overhead expenditure, fixed overhead volume. Volume normally will be divided into 3, but because of lack of information to calculate calendar variance, here it's gonna be 2. So fixed overhead, capacity and fixed overhead efficiency. Okay, formulas will be same. 1 minus 2, 3 minus 2, 1 minus 3, 4 minus 3, 1 minus 4. Okay, let's write all the formula. 1, 2, 3, 4. Here I'll go with frequently used formula, which I've rounded up when I was explaining you the logics behind the formula. Okay, first one AO into SR per unit, second one actual fixed overheads, third one budgeted fixed overheads, fourth one actual hours into standard rate per hour. These are all the frequently used formulas. We'll try to get the answer through these. In case if you are not able to get the answer, then we'll go for the alternative formula. Okay, as usual, because it's an overhead variance, there is one compulsory important step, that is to find SR per hour as well as SR per unit. Okay, now if you look at the question, fixed overheads 3 rupees per unit, so standard rate per unit is directly given, which is 3 rupees per unit. So no problems, I have just taken it up from the question, copy paste. Now what about standard rate per hour? Very simple. If you look at the information over here, each unit is taking 6 hours. You can see that number of hours information in direct labor and variable overheads variance. variable overhead information, 6 hours. So per unit, if it is 3 and 1 unit is taking 6 hours, then per hour it should be 50 paise, correct? If 1 unit is taking 6 hours, per hour rate should be 50 paise, so that 6 hours into 50 paise will give you 3 rupees per unit. So this is one important issue where you will do mistake. Generally, we are not psychologically comfortable by writing 3 divided by 6 is equal to 1.5. Normally, I have seen in the live class, in the face-to-face class, where I have seen students, what they do is that they'll multiply 6 into 3, they'll write 18 rupees per hour. Okay, these are all the tendency to do silly mistakes. Okay, you have to be very careful in the exam. You just need to think patiently. You should have that little bit of diligence. Okay, 3 rupees per unit, 1 unit is taking 6 hours, which means per hour it has to be 50 paise. Only then 50 paise into 6 hours will give you 3 rupees per unit. Simple thought process. Okay, chalo, now let's fill up the numbers over here and we'll finish it off. Actual output, so it is 18,750 into standard rate per unit. We have just now calculated 3. Actual fixed overheads, is it directly given? Yes, it is given in the question here. Actual overheads were 5,65,000, out of which 40,000 is fixed. So it is directly given, which is 40,000. Budgeted fixed overheads, is it directly given in the question? No, but budgeted output is given, which is 20,000, which means write the alternative formula. Budgeted output into standard rate per unit. That implies budgeted output is 20,000 into standard rate per unit, we know, which is 3. That is equal to 60,000. Okay, actual hours into standard rate per hour. What about your actual hours? 1,18,125 into standard rate per hour is how much? 50 paise. That is equal to 1,18,125 into 50 paise. That gives you, right, 9,062.5. Okay, let's calculate. First one, 18,750 into 3, 56,250. Okay, let's do the calculation. 1 minus 2, 1 minus 2, so 56,250 minus 40,000, 16,250 positive. So total variance is 16,250 favorable. Next, expenditure variance, 3 minus 2. So 3 is 60,000 minus 2 is 40,000, 20,000. Again it is positive, so favorable. Okay, volume variance, 1 minus 3. So 56,250 minus 3, 60,000, 3750 negative. So adverse. That implies. Right friends, so fixed overhead capacity variance, 4 minus 3. So 4 is 59,062.5 minus 3 minus 60,000, 937.5 adverse. It is negative, so obviously adverse. 1 minus 4 is efficiency variance. So 1 is 56,250 minus 4, 5962.5, 2812.5. Again negative, so it is adverse. Okay, simple guys. So we have done all the variances in this one single sum, so that you would have practiced at least, it's like 4 sums we have practiced, something like that. Got the point? I hope this lecture gives you a very good idea, at least a decent idea, with respect to how to actually solve standard costing sums. I really thought of starting a process costing in this video itself, but this itself, I think it took a lot of time, because my health is not good. I have you can see my energy levels, I don't know, so I've got a lot of I can say it's not good. Okay, let's not get into the details, but still I just wanted to make a video. I've done it, so if the duration of the video is less, please forgive me for the same. And tomorrow is a Sunday, so Sunday there will be no video, and it also helps me to recover a bit better. I was recovering since last 1 week, but still it's hurting me, so pardon me for that. On Monday you'll have a video where you'll have process costing. Okay, so thank you so much guys, keep supporting. Even the earlier video, you guys have really encouraged me a lot in the last video on standard costing. I really thank those students. Thank you so much for being with me. So I'll just get into that, especially few students like Trinath Srivastava. Thanks a lot, sir. Standard costing was made easy. Focus more on cost accounting systems and budgetary control. Definitely, I'll take your word, buddy, because you have been consistent. Consistently, you guys are supporting me, so I'll definitely take it seriously and I'll do it for you. It's a promise. Thomas Philip, thank you so much, sir. Most of the paid classes of my regular faculties due to price they charge. Okay, sir, can you mention the problems in ICA material? I'll try, Nana, because the time is a factor over here. I just seen that comment, but that's one thing. Taraka Siddhartha, sir, I'm always in debt to you, sir. Until now, I don't know fixed overhead and variable overhead variances in standard costing, but now it's easy for me. Please do as many chapters as you can in this marathon, sir. Definitely, I'll do it, guys. So this is what we actually love. So the consistent, you know, appraisal from you guys. That's all we need eventually. So I hope in this video it would have given you a very good revision of all the variances, how to calculate them. Okay. So in the next video, that will be on Monday. So tomorrow there will not be any video on Sunday. It helps me to recover also. So let me come to my full energy potential. And Monday, we're going to go with process costing. And as my friend has suggested me, we'll be going with cost accounting systems, especially. I'll make it definitely easy for you. I'll promise that. And we'll get into budgetary control as well. That will be the upcoming chapters. Right, guys? Thank you so much. Let's wind up this particular set.